The hardest thing you'll ever do as a trader isn't analyzing charts or managing risk. It's sitting still when there's nothing to do. It's keeping your hands off your keyboard when the market isn't offering your setup. It's watching price move without you and being completely okay with it. Right now, while you're watching this, there are thousands of traders staring at their screens desperately looking for something to trade. Anything to trade, because the idea of doing nothing feels like wasting time. But here's what they don't understand, and what you're about to learn. Patience isn't passive. It's the most active thing you can do as a trader, because it's the only thing that ensures you'll be ready when your actual edge appears. This isn't about motivation or discipline. This is about rewiring how you think about trading activity and building a relationship with waiting that makes it feel natural instead of torturous. Let's start with why sitting on your hands is so psychologically difficult. There's a concept in behavioral psychology called action bias, which is the tendency to favor action over inaction even when inaction produces better outcomes. This bias was demonstrated in a famous study of soccer goalkeepers during penalty kicks. Researchers found that goalkeepers dove left or right 94% of the time, yet staying in the center gave them the highest probability of saving the goal. Why did they dive? Because when they stayed put and the ball went in, they felt worse than when they dove and the ball still went in. At least they tried. At least they did something. Traders experience the exact same bias. When you sit and watch the market without trading, and then you see a move happen, you feel worse than if you'd taken a trade that lost money. At least you were in the game. At least you tried. This feeling is completely irrational because trading isn't about trying or participating. It's about executing your edge when conditions align. But the feeling is powerful enough to drive most traders into overtrading. There's also what psychologists call omission bias, the tendency to judge harmful actions as worse than equally harmful inactions. Missing a profitable move by not trading feels less bad than taking a trade that loses money, even if both cost you the same amount. According to research on decision-making under uncertainty, people consistently prefer errors of omission over errors of commission because taking an action that fails feels more like personal responsibility than failing to act. But here's the problem with how this applies to trading. When you take a trade outside your criteria, you've committed an error of commission. When you don't take a trade that meets your criteria, you've committed an error of omission. Both are mistakes, but traders typically only beat themselves up over the active mistake. Missing your setup by being impatient and taking a premature entry feels worse in the moment than missing your setup by not being at your computer. Yet the latter preserves your capital while the former depletes it. The psychological discomfort of inaction is also intensified by modern trading technology. You have constant market access, platforms designed to make trading frictionless, push notifications, real-time data. Everything about the environment screams trade now, trade often, stay engaged. This creates what researchers call environmental cues that trigger trading behavior even when conditions don't warrant it. According to research on habit formation and environmental triggers, people are far more likely to engage in a behavior when the environment makes that behavior easy and salient. You're fighting against your own psychology and against an environment deliberately designed to encourage activity. Understanding this doesn't make it easy to sit on your hands, but it helps you recognize that the discomfort isn't evidence you're doing something wrong. The discomfort is actually evidence you're doing something right because you're resisting impulses that work against your edge. Let's talk about what patience actually means in professional trading, because it's not what most people think. Patience isn't sitting at your screen for 8 hours watching every tick. That's not patience. That's torture. Real patience in trading means having the self-awareness to know when your edge is present and the discipline to do something else entirely when it's not. According to research on expert traders by Brett Steenbarger, one of the key differentiators between consistently profitable traders and struggling traders is the ability to remain unengaged during unfavorable conditions. Professional traders don't measure their day by how many trades they took. They measure it by how well they executed their process. If their process produced 0 qualifying setups, then 0 trades taken is a perfect day. There's no sense of having wasted time or missed opportunity because they understand something fundamental. Their edge doesn't appear randomly throughout the day. It appears under specific conditions, and those conditions might occur daily, weekly, or monthly depending on the strategy. Think about it this way. If you're a trend-following trader, your edge appears during trending markets. But markets only trend about 25 to 30% of the time, according to analysis of long-term market behavior. The other 70 to 75% of the time, markets are ranging, chopping, going nowhere. If you're trading during that 75%, you're not demonstrating work ethic or dedication. You're demonstrating an inability to recognize when your edge is absent. A trend follower trying to trade range-bound markets is like a surfer trying to surf when there are no waves. It's not noble. It's just pointless. The same applies to every strategy. Breakout traders need volatility expansion. Mean reversion traders need overextended moves. Every edge has conditions under which it works and conditions under which it doesn't. Professional patience means recognizing the difference and acting accordingly. When conditions are favorable, you're active, focused, executing. When conditions are unfavorable, you're doing something else. Reading, exercising, spending time with people you care about, anything but forcing trades in an environment that doesn't support your edge. Research on opportunity cost in trading shows that traders who take fewer than one trade per day on average outperform traders who take more than 3 trades per day by a significant margin, even after accounting for strategy differences. Why? Because low-frequency traders are waiting for their edge. High-frequency traders are creating activity to satisfy psychological needs. The market rewards the former and punishes the latter. Here's what changed my own relationship with patience. I stopped thinking about my edge as something I execute and started thinking about it as something I wait for. My job isn't to make trades happen. My job is to recognize when the market is offering me my edge and take it when it appears. The rest of the time, my job is to preserve capital and mental energy, so I'm ready when the opportunity arrives. This shift from active trading to selective trading transformed my results because I was no longer fighting against unfavorable conditions trying to force profits that weren't available. Let's get specific about what impatience costs you, because understanding the price makes patience easier to maintain. When you take trades outside your criteria because you can't sit still, you're not just risking capital on low-probability setups. You're creating a cascade of negative consequences that compound over time. According to research analyzing trader performance across different trade frequencies, every trade taken outside established criteria reduces overall expectancy by approximately 0.07 per trade. That might not sound like much, but over 100 trades, that's 7 full units of expectancy destroyed by impatience. First, there's the direct financial cost. Trades taken outside your tested criteria don't have the statistical backing of your back-tested edge. They're essentially random with a probable negative expectancy once you factor in transaction costs. Research by Pateince on retail trading behavior found that excessive trading reduced returns by approximately 2.7% annually compared to buy-and-hold strategies, and that excess trading was primarily driven by impatience and overconfidence rather than information-based decisions. Second, there's the opportunity cost. Capital deployed in mediocre trades isn't available for excellent trades. If you're in a choppy, low-probability position when your actual setup appears, you either miss it entirely or you have to exit your current position at a loss to take the good one. According to portfolio theory, optimal capital deployment means having resources available for the highest probability opportunities. Every suboptimal trade you're holding represents capital that should be available for optimal trades. Third, there's the psychological cost. When you take trades outside your criteria, you're training yourself to ignore your own rules. Each violation makes the next violation easier. You're literally weakening your discipline through repetition. Research on habit formation shows that behaviors repeated under specific contexts become automatic responses to those contexts. If you repeatedly trade just because you're bored or you want to do something, you're building a habit of impulse trading that becomes harder to break over time. Fourth, there's the analytical confusion. When you have a mix of trades that met your criteria and trades that didn't, you can't cleanly evaluate your strategy. Your results become noisy. You don't know if your edge is degrading or if you're just diluting it with junk trades. According to research on performance measurement, clean data is essential for valid strategy evaluation. Every off-strategy trade pollutes your data and makes it harder to know whether your approach is working. Fifth, there's the emotional exhaustion. Taking trades that don't meet your setup means you're constantly managing positions that you're not confident in. This creates background anxiety that persists throughout your trading day. You're worried about trades that you know you shouldn't have taken in the first place. According to research on decision stress, managing decisions you're ambivalent about is psychologically draining in ways that confident decisions aren't. The cumulative cost of impatience over a year can be enormous. If impatient trading reduces your expectancy by even 10% and increases your stress levels significantly, you're paying a massive price for the illusion of productivity. Meanwhile, the trader who sits on their hands 80% of the time but executes flawlessly during the 20% when their edge is present builds wealth steadily while actually working less and stressing less. So how do you actually develop this patience? How do you go from someone who can't sit still for 5 minutes without looking for a trade to someone who can comfortably wait days or weeks for their setup? The answer is that patience is a skill that's trained through specific practices, not a personality trait you either have or don't have. According to research on self-control by Roy Baumeister, self-regulatory capacity functions like a muscle that can be strengthened through exercise. The first practice is defining inaction as action. This is a mental reframe, but it's crucial. When you're not trading because your criteria aren't met, you're not doing nothing. You're actively preserving capital. You're actively maintaining psychological equilibrium. You're actively waiting for your edge. Reframing inaction as a specific type of action makes it feel purposeful rather than passive. Research on goal-directed behavior shows that people persist longer at behaviors they perceive as active steps toward their goals rather than passive waiting. The second practice is creating a pre-trade checklist that you must complete before every entry. This checklist should have 5 to 10 objective criteria that define your edge. Is the market environment correct? Is the pattern present? Is volume confirming? Is risk-reward favorable? Whatever your criteria are, they go on this checklist. Then you make it a non-negotiable rule that you cannot take a trade unless every item is checked yes. According to research on procedural controls, checklists reduce error rates by 30 to 50% across various professional domains, including medicine and aviation. They work in trading too because they insert a mandatory pause between impulse and action. The third practice is scheduling specific trading times. If your strategy is based on daily charts, you might only need to check the market once at close. If you're trading intraday setups, maybe you have 2 specific hours when you're actively looking for entries. Outside those times, you close your platform. This removes the constant temptation that comes from having charts open all day. Research on environmental modification for behavior change shows that removing triggers is far more effective than trying to resist triggers through willpower. The fourth practice is having something else to do. Patience is easier when you're occupied with something meaningful than when you're sitting at your desk trying not to trade. If you're a swing trader, you need a job, hobby, or project that occupies your time between setups. If you're a day trader, you need specific activities for when the market isn't offering your edge. Maybe you exercise, read, learn a skill, work on a side project. The specifics don't matter. What matters is that you have a deliberate plan for your non-trading time, so that waiting for setups doesn't feel like wasted time. The fifth practice is tracking patience metrics explicitly. In your trading journal, don't just track trades taken. Track trades avoided that didn't meet your criteria. Each avoided trade that didn't meet your criteria is a win. According to research on behavior modification through measurement, tracking a desired behavior increases that behavior significantly. When you're explicitly measuring how many times you successfully waited for your criteria, you start taking pride in that number. It becomes a metric of skill rather than a source of frustration. The sixth practice is exposure to delayed gratification in other areas. Research on self-control shows that exercising self-control in one domain strengthens self-control in other domains. If you practice patience in your diet, exercise routine, or other areas of life, you're building psychological strength that transfers to trading. The trader who can stick to a workout plan for months can more easily stick to a trading plan. The trader who can save money consistently can more easily sit on capital waiting for the right trade. Part of developing patience is becoming so intimately familiar with your setup that you recognize it instantly when it appears. This familiarity comes from deliberate study and repetition. According to research on expert pattern recognition, experts don't see more than novices. They see what matters faster because they've trained their visual and cognitive systems to recognize relevant patterns. A chess grandmaster sees meaningful board positions instantly. A professional trader sees their setup instantly. Your training should include reviewing hundreds of historical examples of your setup. Not just scrolling through charts quickly, but studying each example in detail. What did the pattern look like? What was the volume behavior? What was the market context? What happened after? This creates what psychologists call a schema, a mental template that allows rapid pattern matching. When you've studied 500 examples of your setup, the 501st example jumps out at you immediately when it appears on your screen. You should also review examples of what looks like your setup, but isn't quite right. These near misses are important because they train you to distinguish your actual edge from close alternatives. According to research on discriminative learning, the ability to distinguish between similar patterns is what separates expert recognition from novice guessing. Most traders can recognize obvious examples of their setup. Expert traders can recognize the subtle differences between valid and invalid variations. This deep familiarity serves multiple purposes. First, it makes you confident when your setup appears so you don't hesitate. Second, it makes you patient when your setup isn't present because you know exactly what you're looking for and you can see clearly that it's not there. Third, it reduces the temptation to trade similar but not quite patterns because you've trained yourself to recognize the distinctions that matter. Research on visual expertise shows that trained observers develop automatic rejection responses to incorrect patterns, making it easier to avoid false positives. Think about how a fisherman waits for fish. They're not anxious about the waiting because they know exactly what a bite feels like. They can distinguish between a bite and water movement or debris. That certainty makes waiting easy because there's no ambiguity. When it's not a bite, they know it's not a bite, so there's no temptation to reel in. When it is a bite, they know it immediately and act decisively. Your relationship with your trading setup should be identical. When it's not there, you know it's not there with such certainty that waiting is effortless. When it is there, you recognize it instantly and execute without hesitation. One of the most powerful mindset shifts for developing patience is moving from scarcity thinking to abundance thinking about trading opportunities. Most traders operate from scarcity. They see every potential move and think, I might miss this. This could be my only chance today. I need to take it. This scarcity mindset drives impatient trading because every opportunity feels precious and fleeting. According to research on scarcity psychology by Sendhil Mullainathan, scarcity creates a tunneling effect where people focus intensely on the scarce resource and make worse decisions as a result. The reality is that trading opportunities are abundant. The market will be open tomorrow, next week, next year. Your setup will appear again. According to analysis of pattern frequency across different markets and timeframes, most trading setups that occur daily or weekly repeat hundreds of times per year. You're not waiting for a rare alignment of planets. You're waiting for a common pattern to reassert itself in regular cycles. When you truly internalize that opportunities are abundant, patience becomes natural. Missing today's setup isn't a problem because you know another one is coming soon. Not trading this week isn't a crisis because you know your edge will appear next week or the week after. This abundance thinking removes the urgency and fear that drive impulsive trading. Research on temporal perspective shows that people with longer time horizons make better decisions and experience less stress than those focused on immediate time frames. You can develop abundance thinking through specific exercises. One is creating a historical frequency analysis of your setup. Go back through 6 months or a year of data and mark every time your setup appeared. Count them. You'll probably find that your setup occurs far more frequently than you imagine when you're in the middle of waiting for it. This empirical evidence that opportunities are regular and recurring helps override the scarcity feeling in the moment. Another exercise is shifting your focus from individual trades to trading campaigns. Don't think about this trade. Think about the next 20 instances of your setup. Your job is to execute those 20 instances with consistency. Whether this specific one works or not is almost irrelevant. You're playing a game that requires 20 iterations to see results. This longer-term framing makes individual opportunities feel less precious. Research on temporal construal theory shows that people thinking about longer time frames make more rational choices than those focused on immediate outcomes. The abundance mindset also helps with the fear of missing out that drives so much impatient trading. When you see a move happening without you, FOMO kicks in and you want to jump in late. But if you know that similar moves happen regularly, FOMO dissolves. You didn't miss the move. You missed this instance of the move. There will be other instances. According to research on FOMO and decision-making, people who maintain awareness of recurring opportunities experience significantly less FOMO than those who view each opportunity as unique and irreplaceable. Here's what I want you to take from this. Your trading setup is coming. Not maybe. Not if you're lucky. Definitely. If you've done the work of defining your edge and testing it, you know the market conditions that produce your setup, and those conditions recur with predictable frequency. Your job is simply to be patient enough to let them arrive naturally instead of forcing trades in unfavorable conditions. Sitting on your hands isn't passive weakness. It's active strength. It's you exercising control over the one thing you can truly control in trading, which is your own behavior. The market will do what it does. Price will move whether you participate or not. Your edge will appear on its own schedule, not yours. Accepting this reality and aligning your activity with it is what separates traders who last decades from traders who burn out in months. The next time you're sitting at your screen feeling the urge to trade when your criteria aren't met, remember that your impatience is costing you money, psychological strength, and analytical clarity. Remember that professional traders aren't professional because they trade the most. They're professional because they trade the best, and trading the best means having the patience to wait for the best opportunities. Remember that every moment you successfully sit on your hands when you should be sitting on your hands, you're building the skill that matters most. Your setup is coming. Maybe not today, maybe not this week, but it's coming. And when it arrives, you'll be ready because you preserved your capital, maintained your discipline, and kept your psychological energy intact. That's the trader you're becoming. That's the patience that builds lasting success. Sit on your hands until your edge appears, then execute it flawlessly. That's the entire game. Everything else is just noise.